Hello, my name's Eric Wilkinson. Many of you may recognize me from CNBC, Fox Business, and the Wall Street Journal for my commentary on everything from geopolitical to economic and market analysis. I've been trading my own money for well over 20 years now, but I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire. But I am here to help you learn to take control of your finances, manage your own portfolio, and most of all, manage your own risk. I've traded most markets throughout my career on the floor of the Chicago Board of Trade. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of those products. I want you to know that this is an educational company, and we're here so that you don't have to rely on anyone else to manage your own portfolio. I'm going to teach you the rules to implement trading strategies into your own accounts, so you can take control and manage your own risk. Having said that, I do have a little bit of housekeeping to go over. This disclaimer talks about everything I mention in these online tutorials are going to be hypothetical or simulated performance results. That being said, I can't give out a specific trade recommendation because I don't know if you guys are watching this 2 years down the road, let alone 2 days down the road. The strategies that I'm going to be talking about in these tutorials are going to be something that are specific time related or time sensitive actionable ideas. So by the time that this gets out, it would not necessarily be the right trading strategy for the time that you may watch this. This goes on to talk about that this is an educational company, so that our advice here is for you to do your own homework. I'm going to teach you how to swim. I'm not going to swim for you. This is going to teach you how to take control of your finances. So the bottom line is, do your own homework. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. I'm sure you've all heard that before. Now this is Options Basics Part 6. This is Part 6 in a series of several online tutorials where I'm trying to teach you all how to trade options. If you are very new to options trading and don't really know the terminology of the different options like the Greeks and things of that nature, you should go back and watch the earlier parts in this series where I go over the history and the terminology that will be used throughout all of these options courses or these options webinars and in these tutorials here. So having said that, the earlier ones are also on a little bit more basic option strategies where we are going to get into the ones that are really going to be somewhat confusing to some people in regards to how the theta and the vega are really going to affect these different strategies. In this section we're going to talk about short call calendar spreads, long call calendar spreads, short put calendar spreads, and long put calendar spreads. These different strategies are really going to be exploiting theta decay and vega decay and or expansion depending on which way we put these strategies on. So the short call calendar spread. The short call calendar spread is basically going, or all of these calendar spreads I should start out to say, is going to take advantage of the different months. So in all of the other online tutorials we've talked about the intra-month and using different strikes and things of that nature within a particular month. This one is going to be spread out among different months, and when you have different month or different expirations within a strategy, the theta and the vega act differently. In the shorter term, vega is not as volatile as it will affect the further out months. Vega really moves the further out months a little bit more, or it affects the further out months a lot more. In the nearer term, even into the weeklies, you're really going to see theta decay happen. Theta does not really affect the further out months because there's such a long time involved there, but it will really affect the near term and especially in the weeklies. So in the short call calendar spread, the trader is looking for the implied volatility, or the vega, to drop dramatically upon entering the strategy, or the underlying to move up and down quickly, up or down quickly as well. The vega reason is because we are short the call in the further out month. And in these calendar spreads, when you see short call calendar spread, you need to think what we are doing in the furthest expiration or the furthest duration option. And that is really where the short call comes in. If we are short an option, we really would like to see implied volatility contract. And we want to see it contract rather quickly to take advantage of that, so it outpaces the theta decay that we are long in the near-term option expiration. To create the short call calendar spread, we're going to buy one call in the near-term expiration, and then we're going to sell one call in a more distant expiration. For example, and in the examples I will be using throughout, July and then August. So July being the near term and August being the further out. And you could even take advantage of it even more by going to the July weeklies, which would have even more of a theta decay. In this particular series, I'm only going to be talking about July and August being the furthest out month. And generally, to create this strategy, we're going to use the same strike. And usually you're using the same strike that is at the money or out of the money. So the short call calendar spread, max profit, is going to be the net premium received. And this occurs when the two options reach parity, in that the underlying declines enough so that both options become worthless, or the underlying rallies so that both options are deep in the money and basically have their intrinsic value. So like I said, we're starting with an out of the money or an at the money, which is very difficult to achieve. An at the money rarely ever happens to have that opportunity arise. So you want to generally default then to the out of the money options and hope that they will expire in the money. The max loss on the short call calendar spread occurs when the underlying remains steady. Now remember, we want this volatility to contract on us rather quickly. So if it remains steady, the max loss is going to be the long premium minus the cost of buying back the short call minus net premium received. Because we collected a premium for shorting this further out month, the further outs are also going to carry a lot more premium. So in this situation, we would have a net credit. And with that net credit, we are hoping that the volatility is going to contract, really causing the premium of the strike that we are short to really come in or come closer to zero, if you will, or lessen from what we sold it for, so that when we buy it back for less than we sold it for. But remember, the max loss, especially on the short call calendar spread, can be unlimited if you blow it. What I mean by blowing it is that you let the long call expire and then you continue to hold on to that short call in the further duration. You don't ever want to do that. The only thing you would really want to do to change the strategy around would be to kind of roll the duration of the front month into a little bit further. If we started out with a July weekly, we could then roll that into the July monthly and try and keep the dream alive that way. But you never want to just let that front month expire worthless and then ride out the short call, because then you are not protected to the upside anymore. Remember, these are defined risk strategies, so when you let that expire, you have no longer defined your risk. And the break even is going to be the cost of closing the position minus the net premium received. Now, I know that these max losses, break evens, and all of these are going to be a little bit vague, kind of like this break even. And the reason being is we can't tell exactly what Vega is going to do. It could expand or it could contract. And if it does do that, your break-evens are going to change along with that change in vega, change in theta. And with the example here, as you can see, it shows that there is pretty much a defined break-even on this graph, and that break-even crosses at the dotted line. Now, as you hold this for an extended period of time, that break-even is going to change also along with, you can see where the vega is and the theta is under the price slices. And at the very bottom here, I show the calendar spread. What I did, I sold one August 15 62.5 call, and I bought one July 62.5 call. Then below that, I just kind of broke it down into the parts so that you could actually see what kind of premiums are involved in each one of these. As you can see, in the August 15 62.5 call, we had to do it at $2.36. That's what we collected, and then we had to pay for the July 62.5 call, and we paid $1.70, as you can see there. Now, in this strategy, we collected a total premium of 65 cents. Now, when the net premium received is 65 cents, our break even at the point of inception is going to be 65 cents above or below the strikes. But keep in mind that it really is the cost of closing the position, because this credit can go up and or down depending on the vega and the theta and how they are going to affect each one of those premiums.